Monday, the 9th of October. It says on the screen December. Believe you me, it's not. We're not there just yet. Let's talk a little bit about what we're seeing in markets today. The horrific events of this weekend obviously continuing to reverberate around the world. Let's talk a little bit about how the markets are reacting. As you would expect, I think is all I can say at this point. You've got a risk-off event, bonds are being bid, oil is being bid, stocks are on offer, defense stocks are being bought, airlines are being sold. None of this really tells us much about what comes next. That's the critical question now. Where do we go from here? We've seen the impact of the conflict in Ukraine. Are we seeing another one of those starting to manifest themselves in global markets? We simply do not know yet. So that's the reaction in equities. You've seen the reaction in the bond market. Treasuries are closed. Volumes reasonably light. We don't actually know very much information at this stage. We're going to talk about it, though. We're going to try and get you an idea of how to hedge some of the risks. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So you go. Stock 600, down by 0.4%. It's been bopping around all over the place all day. No clear sense of direction. Treasury markets in the States are closed. Volume's a little light. That's about as far as you can go with that one. Single stocks, Shell catches a bid, energy's up. No surprise there. That's the obvious reaction. That's one of the safety trades you're seeing. In terms of one of the kind of the opposite end of the spectrum, Air France is down by 9% today. Obviously, there's an impact on air travel here. You've got Russian airspace closed. Now you're beginning to effectively close off another piece of airspace as well, or certainly limit its use. You've got higher oil prices. All of this, obviously, not good news for the airline sector. Air France is down by over 9% right now. So there's a kind of obvious kind of first steps that the markets are taking. Not enough information to take the second steps, the third steps in terms of understanding, Alex, the impact, the wider impact that this new conflict could have.
What is so interesting is that it does feel like if it's a natural gas story, that would affect Europe in many ways a lot more than the U.S., or even oil, to be honest. But it's the U.S. equity market that is seeing a little bit more downside. Yes, volume is light, as you pointed out, but tech is off by 0.8%. S&P is off by about 0.5%. As very similar to Europe, though, you have the underperformers, the travel stocks, you have the outperformers, the defense stocks. Something you would very much expect coming into today. The VIX elevated. We talked about that in terms of the other areas of financial markets. Crude also elevated, up by 4%. Although I do want to echo what Ed Morse was saying over at Citi. When you usually have a geopolitical event like this, crude moves can be enormous. This is not an enormous move, and that's quite interesting in how the market is absorbing volatility, and the dollar a little bit bid here, up by 0.1%. It will be interesting to see how treasuries, when they open tomorrow, how they trade, Guy.
Absolutely. And we'll get a better idea at that point, and the day after that we'll get a better idea as well. The sense is we're now waiting for how Israel is going to respond, and then markets can maybe price in the next few steps. Ron Dermer, Israeli Minister of Strategic Affairs and former Israeli ambassador to the United States, joining Bloomberg Television earlier to talk about how Israel will retaliate after Hamas launched this surprise attack. Over 1,000 people now dead.
And we're going to have to crush both their capability and also their spirit. They will rue the day 2 days ago. We're going to remember that day. Israel will always remember that day. But all the terror organizations around us are going to remember this period for a very long time, and the critical miscalculation that Hamas made, thinking that it was going to be business as usual in Israel. Believe me, it is not. The people are outraged, and they have awoken not a sleeping giant, but a sleeping Maccabee. And they're going to see it in the days and weeks ahead.
Very, very strong words setting the stage for this conflict. And that brings us to the question of the day. With so many unknowns, right, how should investors react to what's unfolding in Israel? So we want to get some more insight here with Eddie Vanderwalt from our MLive team, Michael Masika from our equities team as well. Eddie, let me just start with you, because you sort of bridge the gap in many ways with commodities and then the economy and stock markets. How should investors be reacting right now?
Yeah, you know what? I think we've seen a really interesting reaction in markets. These are obviously tragic events, and the effects are much bigger than what's happening in markets. But what we're seeing at the moment is that investors are generally cautious, trading somewhat risk off. but not overreacting, right? They are waiting to see how exactly as Guy said, what the next steps are, just exactly how the situation develops from here. The market will be very much led by the politics here. And one of the big question marks is how much oil supply will be disruptive. Because what we're seeing at the moment is things like, we're seeing oil outperforming, we're seeing gold outperforming, we're seeing the yen slightly bid, we're generally seeing, European stocks outperforming, sure, but that's also on the back of energy stocks outperforming. So what we're really seeing is the market saying, look, at the moment, this is a nervous time for markets, but we're going to wait and see, what the escalation is and whether there is an impact on the flow of oil. And if that is the case, then I think we're gonna see a real, ripple effect across markets.
Michael, you've traded things like this. You've been in the situation where you're a portfolio manager. You got an event like this on a Monday morning. What do you see in terms of the reaction that markets are delivering thus far?
Well, Guy, this is like Eddie was saying, this is a very complicated story because it hasn't unfolded at all. Yep. We are just at the beginning. We don't know what's the impact going to be, what's the react going to be. Oil hasn't reacted much, really. Oil prices were much higher 2 weeks ago. Goldman Sachs has an estimate that oil will rise to $100 by next June, and they had that estimate way before the conflict even started. We are around 85 at the moment. Mm-hmm. So a lot of upside potential on oil and on the impact it could have both on equities from like a portfolio manager perspective. Definitely, European oil equities, energy shares are something that people might want to look at. Defense is something that people might want to look at. Yep. We've been seeing it today, defensive equities to protect your portfolios. But even before that, there was some very big caution on the market. I mean, last week, there was a huge spike in put volumes in the US. So already, people have started hedging their portfolio, and that could be something that helps the market, that people are not complacent. Yeah. They are already hedged for part of them, and so that may help the markets in the next few weeks.
Yeah. What's interesting is that Goldman did say that even if the Saudi production cut stays, it only adds $4 to the price of oil for their forecast. So it's not even tremendous in that respect. Michael, hedging, though, geopolitical risk, honestly, ever since Brexit, just hasn't paid off. Why? And is there a way to kind of manage that differently?
Look, at the end of the day, I mean, historically speaking, keeping a very, very cold market approach here, but financial markets don't tend to react too much to geopolitics. Usually, you have very specific sections of the markets that are highly impacted. Oil will be the one that is mostly impacted because in case of an escalation, this is where things might change in terms of supply, but also, in terms of like how things will evolve on the ground. So I think overall, there's no panic, and there's rarely panic on geopolitical events unless they're very, very large scale.
Eddie, though, as you both said, we don't know what comes next. The oil market, relatively muted today. We're up by around 4%. But you need to see that in the context of kind of where we've been recently. We've come up, we've approached 100, we've backed off that a little bit. But if we end up with higher for longer energy costs, how does that change the market narrative? That is going to be something that the Fed is going to have to think about. Central banks have traditionally or recently looked through energy spikes, but they're learning the lesson that actually that could be a mistake. So if oil stays at, 85 to 100 for the next 12 months, how does that change the valuation of other assets? Yeah.
Look, Michael's absolutely right. Geopolitics generally, it's something that creates headlines, it creates ripples in financial markets. And it's quite often very quickly faded. We see that in gold. We see that the exception is when oil prices are affected and when the flow of oil is affected. We saw that with Russia last year, right? When the real supply of energy is impacted, that feeds through into markets because it impacts inflation. And I think for that reason, what is really interesting to me is how the Treasury market has responded. I know that, of course, the cash Treasury market is closed today, But even in the futures market, what we're seeing is a bid for treasuries. We're not seeing people trading a higher for longer energy prices. They're not trading the inflationary, impulse. They're not even just buying the shorter end and selling off the long end. What they're doing is they're moving into treasuries. This is a risk off event right now, and they buying treasuries off the back of that, and therefore we're seeing yields coming. We're seeing yields moving accordingly. Now, I don't think that's, I think that this is definitely the one key thing. We're going to have to be very careful over the next few days to assess what the wider impact is, how the oil market more widely and the flow of oil is going to be impacted or not. And I think that will be the key input into how the rest of the market reacts.
Really interesting and good conversation, guys. Really valuable. Thank you very much. Eddie Vandervalt from our MLive team, Michael Masika from our equities team. Thanks, guys. We appreciate it. So coming up, we're going to get more perspective on that question of the day. How should investors react, and how do you think about allocating right now? Seema Shah, Chief Strategist at Principal Asset Management, joins us next. This is Bloomberg.
Hamas started a cruel and evil war. We will win this war.
The whole country is still wondering and in shock. It's incomprehensible, and we're still waking up and hoping it's a nightmare.
The Palestinian people, the Palestinian Mujahideen, all Palestinian groups, and the Islamic Ummah should be congratulated.
This is Israel's 9/11. This is Israel's 9/11.
The United States stands with Israel. We will not ever fail to have their back.
Israel cannot wage a full-scale war on a nation, its people, its land, its holy sites, and expect peace in exchange.
Hamas and the people who support Hamas are fully responsible for this appalling act of terror.
Israel will do everything to bring our sons and daughters back home.
World leaders reacting to the crisis in Israel. We don't know yet what comes next, and I think that is the issue that markets are really struggling with. How do some of those tensions those leaders were vocalizing get resolved? Do they get resolved? And in what form do they get resolved? That's the question now, and I think markets are in wait-and-see mode. So how should investors be reacting? We've seen the initial kind of obvious reaction. You buy treasuries, you buy bonds. Treasuries are closed today. You buy oil, you buy the dollar, sell some equities. But oil's doing well today. Defense stocks are doing well. Those are the kind of initial reactions. What comes next, I think, is more difficult to determine. Seema Shah, Principal Asset Management Chief Strategist, joining us now. Seema, you come into work this morning, you come in on a Monday morning after a weekend that we've just seen these terrible events unfolding in. How do you think about how you approach a market on a Monday morning like today?
Hi, Guy. Thanks for having me on. Yeah, look, it's difficult. It's we're almost, especially with the US bond market being closed, that certainly does make the situation even more difficult to navigate. I think the overlying impact, as you said today, is just one of uncertainty. So the wise thing to do, I think, is kind of stick to almost a neutral positioning, because this can go many different ways. The thing that we're going to be watching over the next kind of weeks, months or so is really going to be oil prices. Because as Eddie was saying, sometimes the direct impact from geopolitics is quite short-lived. Mm-hmm. It's really those indirect market impacts, the kind of the second-hand effects, which are what can be more persistent and potentially more damaging. Mm-hmm. So that's what we're going to be watching. We're going to see what the impact on growth, inflation, of course. Those are the two kind of macro indicators, the second-round impact. And then, of course, how do bond yields move? And then from the back of that, what happens to equities?
So, Seema, what's so interesting is that I think this month is the 50th anniversary of the oil embargo in the U.S. And the landscape of the oil market and natural gas market is so drastically different that I wonder how you look at the transmission mechanism from volatile or high prices into the economy, into central banks, into the equity market, when we're just in a very different place. Like, the U.S. produces, 12.9 million barrels of oil a day.
Yeah, and you're right, because, there has been the obvious comparison to make. And, thinking about that period in the 1970s, immediately there was maybe a bit of a rally in bond yields. But then as inflation expectations started to move higher, and you knew that the Fed was going to be responding with a very aggressive action, well, then it was a very different picture. So that is what his investors are looking to and saying, are we going to have a repeat of that? But as you said, the situation today in the oil market is so very different. As you said, the US is a net oil exporter, so its economy is less vulnerable to the kind of moves in oil prices that you would have seen back then. I would say that also right now, the one similarity that you do have, which I think is very important for investors to be aware of, is that just as then, today central bankers are very cautious about inflation. We came into this weekend knowing that the central bank would be very wary of where inflation, the future path would be, and as a result, they would have to stay fairly hawkish. Maybe at some point they would indicate that they were in pause, but that narrative actually isn't that different today than it was on Friday. So if anything, I think this just adds to that narrative that the Fed, other central banks need to be very alert. It probably means that rate cuts maybe a little bit further into future. But as I said, this is day one from a market perspective. So we just have to almost see how this is unraveling. And that makes even more of a case for thinking about neutral diversification, kind of all those very standard geopolitical playbook rules. They definitely apply today.
Why, Seema, why do I need to diversify? Cash is delivering 5%. Why do I need to diversify when you can protect yourself in a way that you haven't been able to for many years?
It is a good point. But I would say that given the volatility that you've been seeing in the bond market, that stuff doesn't go away. We still do have concerns, or the market should still have concerns about Treasury issuance, the size of the deficit. You still got the kind of the spectre of the Bank of Japan and what they're going to be doing. So actually, I don't think the bond market, think about the fundamentals, is really that smooth. So I would question whether or not the fixed income market is even going to outperform equities over the coming months. So yes, you do need to have an eye on the geopolitics, but don't forget the fundamental narrative, which is still there today. And, in a week's time, 2 weeks' time, who knows, if things do settle down, well, then you've still got to go back to thinking, what are those fundamental concerns that I had 2 weeks ago, and how are they going to impact my portfolios?
I mean, that's what Lori Logan of the Dallas Fed was talking about earlier, just in terms of, say, bond market developments have been orderly to the point that they get worried when something's disorderly. And I'm wondering, and that's sort of the fundamental longer-term view, right? What would disorderly look like to you, Seema, and how do you sort of read the tea leaves to that?
Look, so at this stage in time, we're not detecting any kinds of really financial strains. So we're not too concerned. We think that you can actually get 10-year Treasury yields up to 5% and not have to be thinking too much about stresses. It's really when you get to the 5.5%, 6% level, and of course, taking into account, it's really about the speed that things are moving, that maybe the disorderly concerns start to come in. Because ultimately, this is still a fairly strong macro backdrop. We are expecting a slowdown in 24, but we're not expecting it to be particularly deep. So there's a lot of macro fundamental factors which suggest that actually yields should be higher today than they were 6 months ago, a couple of years ago, 10 years ago. So I think you do have to take all of that into account. But the thing that we're going to be watching is what is the speed? If you're going to see a continuation of the sell-off at that pace that we've seen over the last 4 weeks continue for another 4 weeks, then I think you could be looking at some strains. But that doesn't seem very likely at this stage.
Hey, Seema, great stuff. We really appreciate your perspective today as we kind of work through all this. Seema Shah, Principal Asset Management, thank you very much. Coming up, you got UK Labour leader Keir Starmer saying his party is on track to return to power at the next election. We're going to look at the future of the UK government coming up next. This is Bloomberg.
In the next Parliament, we want to achieve that mission of having the highest sustained growth in the G7, with good jobs and productivity in all parts of the country, making everyone, not just a few, better off. And today at conference and tomorrow in Keir Starmer's speech, we have set out today exactly how we're going to achieve that.
That was UK Shadow Chancellor Rachel Reeves speaking earlier at the Labour Party conference in Manchester. The party now holding a double-digit lead over Prime Minister Rishi Sunak's Conservative Party. So for more, we're joined now by Bloomberg's Lizzie Burden, who's been covering this all day. And Lizzie, the backdrop to this is a very difficult weekend with an Israel-Hamas war. And I'm wondering sort of what the conversation was on the ground.
We've had a strong condemnation to start the day from Keir Starmer, the opposition Labour leader, echoing the Prime Minister Rishi Sunak and, of course, other European leaders as well. He called the attack by Hamas appalling. And it's in contrast, really, to the former Labour leader, Jeremy Corbyn. He, you may remember, before he became Labour leader, shared platforms with supporters of both Hamas and Hezbollah. And on Friday, he posted on Twitter, on X, I should say, that he didn't condemn the attacks. In fact, he emphasised the impact of Israel's occupation. And you'll remember that after losing the 2019 election to Boris Johnson, Jeremy Corbyn was suspended from his Labour Party membership in October 2020 for saying that the anti-Semitism that was found in the party had been overplayed for political reasons, and he wasn't restored the whip after that. So it's against that historical backdrop that Keir Starmer has returned to this traditional foreign policy stance. And you can imagine that he's probably pretty relieved that he was so ruthless, in his own words, in terms of his handling of the Corbynite wing.
Absolutely. Lizzie, he's done this relatively quickly within one parliamentary term. He's brought Labour back to the centre ground. Is there a sense that that will, though, stick? This is the critical message that he has to deliver, that this journey is one that has traction. Do you think he's capable of delivering that at this conference?
Well, look, I was speaking to Luciana Berger, who quit the party. She's a former Labour MP, over the anti-Semitism in the party. She's back here today. It's the first conference she's been to in 5 years. Hugely symbolic. And she had a front row seat at the Shadow Chancellor Rachel Reeves' speech because she seems to think that the mission has worked in order to stamp out that anti-Semitism in the party. Of course, going forward, it's going to be difficult for Keir Starmer. The more the situation unfolds in the Middle East. But that's a fine line that Keir Starmer is going to have to tread going forward and to prove that he has completely stamped out that anti-Semitism.
Lizzie, thank you very much indeed for the coverage. Bloomberg's Lizzie Burden joining us from the Labour Party conference. The European markets are about to shut for the day. We'll deal with the details of that close in just a moment. Energy stocks catching a bid, defence stocks catching a bid, airlines certainly under significant pressure. We'll deal with the details, as I say, in just a moment. The close is next. This is Bloomberg. The Monday after a weekend of horrific events in Israel, everybody's taking stock, trying to figure out exactly what comes next. European equity markets, volumes a little light, but not really. You're seeing the classic playbook unfold in this kind of situation. Energy is higher, energy stocks are higher, defence stocks are higher. It looks like you're going to see Ukrainian funding, Israeli funding being put into potentially one bill in the United States. That's certainly the expectation we're hearing from DC. So defence stocks go up. Names like Rheinmetall, Saab, BAE Systems, they rise. Names like Shell go higher. BP, they go higher. You're seeing retail under pressure today. You're seeing airlines under pressure today. This is another piece of airspace that is now going to be tricky to use. This is higher oil costs. That feeds through into kerosene, jet fuel. That's more expensive. There's likely to be some disruption. There's added risk that obviously the airlines get caught up in this. That gets priced into the market. Retail's a little softer as well. So that's basically the picture, the playbook that we're seeing kind of work its way through the system today. London's flat. Defence oil stocks up, retail stocks, airlines down. It's a similar narrative, to be brutally honest, elsewhere. 443, we're down by 0.2%. The market is basically within itself rotating, but at an index level, not moving. And again, that's a very similar kind of narrative to the one we've seen playing out. There's not much yet. There's not really enough information yet for markets to react one way or the other. So IAG comes down by 5.85%. I could have picked Air France here. I did earlier. you're seeing airline stocks coming under a little bit of pressure, unsurprisingly. Oil stocks, energy stocks go higher. Shell is up by nearly 3%, 2.8%. Defence stocks catch a bid as well. I could have picked Saab here. I could have picked BAE Systems here. Rheinmetall is up by 6.54%. These are all fairly straightforward reactions in a market that in some ways doesn't have enough information to make clear decisions about what comes next. The transmission mechanism is through energy, but we don't yet know how kind of sticky that reaction is going to be. We'll wait, we'll see. The Treasury market's also closed today, which probably doesn't help. What else are we going to get throughout the rest of this week that's going to inform this debate? We're going to see a continuation of what's happening in the consumer slowdown, maybe in the LVMH numbers. They come through at kind of this time tomorrow, sales and revenue numbers. We've already heard about what's happening in China. You've seen the data coming out of China over the weekend, which I think is a factor here as well. Not great, the data, basically from the holiday period. The US is slowing down, Europeans beginning to slow down as well in that sector, so that's going to be useful. The Bloomberg New Energy Forum summit taking place in London, watch that as well. Going to see some really sort of smart people coming together there to give us an idea of what's happening. The Labour Party conference continues. This is being presented by the Labour Party as a government in waiting. And then we get to the World Economic Outlook from the IMF, and I think this meeting could be quite interesting. There's a lot of uncertainty right now. We're trying to figure out how you price all that in, how central banks are going to be reacting, what's happening with economies, what higher oil prices are going to mean. It's a really difficult spreadsheet to kind of a really difficult model at the moment to try and get right. And I think the IMF meeting could be quite interesting in terms of the narratives that we're going to be hearing from a series of people, Alex. There's a bunch of very smart people coming together here.
Yeah.
Are they going to be able to give us smart answers to what comes next?
Well, ECB President Christine Lagarde said today that the IMF has actually cut its forecast for the global economy. And now you have Israel and Hamas war injecting even more uncertainty into global economies, also when it comes to oil and then what it means for natural gas prices. And that's a real Europe story as well. So let's go through some of this with Anna Stupniewska, a global macroeconomist at Fidelity International. Anna, what do you think we're going to get tomorrow? But then how do we put the overlay of what happened over the weekend onto those numbers in that forecast?
Yeah, I think the IMF, the World Bank meetings are happening in a very tricky environment. The clouds have been gathering already over the global economy. Obviously, growth is slowing everywhere except for the US for the time being. Inflation is sticky. Financial conditions have tightened so much. And now we have this another layer of uncertainty coming from the Middle East and the potential shock to headline inflation that can feed to core and can feed to inflation expectations, which is making the central bank job even trickier now. So this is a very tricky environment for the IMF, for the World Bank, and I think the outlook will be downgraded in terms of growth because these are the headwinds that are gathering.
Economists are having a very tricky time of life at the moment because their expectations, their predictions seem to not be coming true. The US economy has been much more resilient. The global economy has been more resilient, but in pockets. What do you think the degree of certainty that those gathering at these meetings have about what comes next and what the economy is really doing?
The degree of uncertainty within the meetings. Well, back in April, I was at the IMF World Bank meetings, and the overall sense was that of cautious optimism, because the meetings came on the back of the crisis in the banking system, which was handled very well by central banks, and there was cautious optimism. The IMF outlook was called uneven recovery, so they were talking about recovery. And yes, there has been resilience, but mainly, as you say, on the back of the US economy. Other economies have disappointed, including China. Europe is probably now in recession. So I think the degree of confidence is probably low because there are so many moving parts there.
Do you think, Anna, that there'll be another kind of energy shock or energy crisis in relation to what's unfolding geopolitically as well? Because Europe clearly the most exposed to that.
Look, it's possible, and obviously you have been covering the transmission mechanism through the oil price, and I think directionally we are looking at higher for longer oil, higher for longer inflation, higher for longer policy rates. As I said, it's very important in what happens to actually expectations, even if there is no significant pass-through to core inflation over the medium term. Inflation expectations are sensitive to headline inflation and to commodity prices in particular. So I think we might see another inflation shock, and the central banks will have to choose whether to continue fighting inflation or prioritize growth. And actually, interestingly, I was looking at some chapters that the IMF has released already. One of the chapters is focusing on commodity markets and fragmentation. So they've been talking about fragmentation a lot, and now they're trying to assess the cost of fragmentation that we see in commodities in terms of the economic impact and who are the winners and the losers. And this chapter comes at a very pertinent time. And I think it is that fragmentation and the related loss of output and high inflation that we will have to be
And that
tracking.
fragmentation leads to structurally higher inflation.
Yeah, structurally high inflation, and loss of output because you have different countries. Slow growth, yeah, exactly.
But structurally high inflation.
Yeah.
So are we heading, do you think the message will be actually that the risk of stagflation is now significantly increased?
I think it is higher, and again, there are structural factors like, for example, net zero transition. They're also talking about climate change in their latest outlook. That is going to be highly inflationary. It's clear that we're going to need a carbon price, whether it's tax, whether it's some other measures. But I think the IMF is trying to bring it to the table a bit more now, and I think for sure they are acknowledging that the risks of structurally higher inflation are there, and that's why they have been encouraging fiscal policies, the governments to withdraw fiscal policies to help the inflation fighting in the meantime.
Yeah, that could be tough to do, though, in a recession. We'll see what happens. Anna, nice to see you. Thanks for stopping by to see us. Anna Stupniecka. I think I'm doing that wrong. How do I say it?
Stupniecka.
Stupniecka. There we go. Maybe we'll get it right the second time around. Global macroeconomist at Fidelity International. Probably should have checked that earlier. OK, this is where European stocks have finished. These are the final numbers on the day. As you can see, little softness coming through towards the end of the day. We have, though, seen a fairly textbook reaction today to what we've seen over this weekend, the horrific events unfolding in Israel. Defence stocks have been bid, energy stocks have been bid, retail is off, travel and leisure stocks are significantly softer. So those are the final numbers today. I think as the week progresses, you'll get probably a little bit more clarity and a better reaction, a better understanding of the reaction the markets are going to deliver. Coming up next, we will take you back to that Middle East story and the impact that it's having on oil. Oil prices are higher. Amrita Sen, Director of Research at Energy Aspects, is going to join us next. This is Bloomberg. This is Bloomberg Markets. You're looking live at the principal room. Coming up, Rebecca Babin, CIBC Private Wealth Group Managing Director, joining Bloomberg Television at 1:30 p.m. New York time. This is Bloomberg.
You'd expect a jump between 5 and 10%, and it's been a less than 5% jump. Even if we look back a couple of weeks, prices have gone down a lot more than they've recently gone up. So it's been a blip. It's not been the kind of response you'd expect after a big event.
That, of course, was Ed Morse, Citigroup Global Head of Commodity Research, speaking to Alex and me in the last hour. Let's talk more about what is happening within the energy complex and talk about its reaction to what we're seeing, the horrific events that have been unfolding over the weekend and into Monday. Amrita Sen, Director of Research at Energy Aspects, joins us now. In many ways, Amrita, Ed is right. It hasn't been a big reaction. We've seen, let's call it circa 5% uplift in terms of the price of oil, but we're still kind of below where we were even a few days ago. What signal can I take away from the shift in pricing that we have seen? What's been priced in? What's been priced out?
Look, first and foremost, what we saw last week, very much positioning driven. And remember, we've got a lot of options expiry. So we do get October, November. I'm sure you remember end of November is always one of those periods as well. And October as well. You do see this kind of volatility around expiries. But I wouldn't necessarily read too much into that. The scale of the move was massive, but it was essentially a $10 move, right? We also moved from 85 to 95 pretty quickly, maybe not in like 2 sessions like we did on the way down, down. And now we are kind of crawling back up close to 90 now. The reaction, what we've seen right now, I would argue, is the market pricing out the fears that Saudi Arabia might be bringing back the voluntary cuts quicker than expected because of the diplomacy going on between, or was at least going on between US, Saudi and Israel. We continue to say that, look, these fears are completely unfounded. My conversations with Prince Abdulaziz kind of confirmed the fact that oil wasn't even a part of the conversations, but the market was very, very afraid of that. Yeah. That's been taken out because of the events over the weekend. Clearly, those talks will slow down, potentially get derailed. We have to see. But the market's definitely not pricing in an escalation which involves Iran. That is yet to come.
So that was my next question. The obvious fear that the U.S. will crack down harder on sanctions on Iran after there was basically some loosening up, even if it was de facto. How should one price that, and what do you think the reality of that will look like?
It's a challenging one, right? Because most of that Iranian oil is going into China, and which is very, very hard to enforce anyways. So, yes, the U.S. had turned a blind eye, and maybe now they kind of turn around and say, look, you know, that there will be certain measures or just more of a scrutiny. Potentially a little bit of volumes come down, but at the end of the day, it is only China that's buying it, and it's very hard for the U.S. to enforce any kind of sanctions, given the route that Iran is right now taking to China. I think that's the challenge they have. But yes, I think generally speaking, you might get a bit more vocal U.S. administration, and they had turned a blind eye. You could definitely expect some more, just a bit more scrutiny around those volumes.
Amrita, what is not knowing what comes next worth in terms of the oil price? And have we seen that to a certain extent already? What's the geopolitical risk valued at, do you think, currently in the oil price? And what could it be valued at?
It's a great question. I don't think it's very high, given, you know, what we've seen is, again, the pullback has been pretty severe, and people are kind of starting to price in a little bit of okay, at least Saudi Arabia is not going to bring barrels back early. But geopolitical tensions, generally what ends up happening, and remember, even for the attack that happened on Saudi Arabia in 2019, we had this big spike, and it does tend to come back down. So even right now, I wouldn't say there's a lot of geopolitical risk premium in prices. We don't even have a lot of disruptions right now. Libya, Nigeria, they're all operating more or less, given where they have been in the past. But even Libya, there's definitely noise around certain kind of, you know, events there. So we should be watching that as well. So I don't think the market's frothy, if that's kind of, you know, the geopolitical risk premium that you're asking. Not a lot in the price right now.
So Guy actually asked me this question earlier, Amrita, and he's like, well, I'm paraphrasing. Why can't the U.S. just pump a lot more? If like something's happening, can they actually get more oil out of the ground quickly? And I was like, I'm not sure. I mean, you're already pumping 12.9 million. It's going to take at least, 6 to 9 months, 12 months to get more out. And we've kind of maybe reached the peak of getting out all the good oil. Was I off base there, or do you feel like that's kind of right in the market?
No. You were in Oklahoma City with me. How can you be off base? This is exactly what people were talking about. Alex is right. We are peaking out at around 13 million barrels per day. The best quality acreage has been drilled. And as you know, we heard there from a lot of the executives, the general environment hasn't been particularly conducive to continue producing. But I think for me, the geology is far more important than the regulatory scheme. But we are peaking out in terms of the pure black oil, not NGLs, not gas. And we do have growth slowing quite substantially next year.
So should we expect higher for longer oil prices? Is that the takeaway from all of this? And how do you think that manifests itself globally in terms of the demand story? If say we're in the kind of 90 to 100 range, I don't know, what does that do to growth?
So I think 90 to 100 is very, very plausible. That's kind of where our price forecasts have been for Q4. It is for next year as well. And again, because if you're not producing in the tier 1 acreage for shale, your cost of production or the floor is no longer in the 60s, now is in the 80s. So the 90 to 100 is a fair price, potentially. In terms of growth, right, I keep saying the crude oil price matters a lot less. What matters is what are gasoline and diesel prices doing. Gasoline prices have come off. It's seasonally winter, and you don't get a lot of gasoline demand. So at the pump, we're not paying the particularly high prices. That's the most important factor, I would say. Diesel, of course, is much higher. Purchasing power is a lot higher as well. My concern right now with 90 to 100 is not the price level. I mean, that's absolutely fine. Emerging market is fine at these prices as well. It's much more on top of high interest rates. If savings are also being depleted, if interest rates continue to rise, does that put additional burden on the consumer? I don't think the jury is out yet, but that's the concern I have for next year. We already have demand growth slowing from over 2 million barrels per day this year on year, to about 1 million next year. But that's not a function of oil prices. It's much more to do with the economy.
Right. Hey, Amrita, it is always good to see you. Thank you so much for checking in with us on this. You're such a pleasure. Wonderful analysis. Amrita Sen, Director of Research over at Energy Aspects. So coming up, the other layer of this is what's happening in D.C. This obviously leaves a lot of pressure to find another Speaker of the House to kind of figure out how the government will be supporting Israel in the Israel-Hamas war. We're going to get the latest from D.C. next. This is Bloomberg.
We must enforce harsher sanctions, cut off Iran's ability to export oil, and to refuse to enter any future nuclear deals.
That was former U.S. House Speaker Kevin McCarthy addressing U.S. sanctions on Iranian oil as the Israel-Hamas war rages on. So let's get some insight here as to how Washington is going to be addressing the crisis. Is Bloomberg's Kayleigh Lyons. Kayleigh, can Washington do anything without a functioning House?
Frankly, Alex, no. At the moment, they cannot. Of course, the House is going to try this week to elect a new speaker. Kevin McCarthy is the speaker. No longer Jim Jordan and Steve Scalise are in the running, but either one of them is going to need a majority of votes, basically the entirety of the Republican conference, and it's not clear either one can get that. In the meantime, we have an acting pro tempore speaker, Patrick McHenry, and it's unclear what he can really preside over. Frankly, it's unclear if he can even participate in Gang of Eight intelligence briefings at the highest level. So really, we are looking at a Congress that is paralyzed here to act, at least in the immediate future, if there is congressional approval needed for any further aid to Israel. And that really is going to be a challenge as we move forward. Also, keeping in mind the Senate is out of session right now. They're not returning next week, and they have yet to even have a confirmation hearing for Jack Lew, who Biden has nominated to be the new ambassador to Israel.
So what happens next? Does the situation in Israel in any way change anything in Washington, D.C.? Does this have any effect on the politics there?
Well, it may make things more expedient. We already have heard that there is going to be that confirmation hearing for Jack Lew just 2 days upon the return of the Senate next week. So they are trying to move that in a much quicker manner. Then, of course, it does add some pressure to House Republicans to get a new speaker elected, to have this other half of the legislative branch functioning in this moment. That still is going to face difficulty. And while Israel and support for it is largely a bipartisan issue, you are also starting to see some partisan fault lines here. A lot of what we just heard from Kevin McCarthy, the former speaker, was about the Biden administration's Iran policy, specifically the move last month to unfreeze $6 billion of Iranian assets in exchange for the release of 5 Americans that were detained in Iran. He said that the immediate priority for the U.S. and Israel needs to be the return of American hostages, and that, frankly, policies of appeasement just won't work anymore. So Iran policy is going to be a real focal point as this moves forward.
Kayleigh, do we have an idea of when you would take a look at, say, the budget versus Ukraine aid versus Israel aid, how do they intersect or not?
Well, the U.S. already has committed to provide billions of dollars a year to Israel. That is something that was agreed to under the Obama administration. That funding still is there. It's just a question of if Israel asks for anything additional, any specific assistance. That is something that may need congressional approval and where some of the hiccups may lie. This does underscore, though, the difficulty around funding for other countries facing other conflicts, specifically like Ukraine. Of course, there is a lot of skepticism among members of a lot of the Republican conference on giving Ukraine any more funding. And Israel, of course, one of the U.S.'s closest allies in the Middle East. Ukraine, an ally in a different part of the world that is also contentious. So it really just spotlights the difficulty around all of this funding, keeping in mind that no funding is getting passed in the immediate term until we have a Speaker of the House.
Yeah, Kayleigh, thanks a lot.
It's going to be interesting.
Yeah, go ahead, Guy.
So it's just going to be interesting. Do you think the two end up getting rolled together? We'll wait. We'll see what happens there, Alex. That's certainly what I've been hearing today.
All right, well, Kaylee, thanks a lot. We really appreciate it. Obviously, lots more to follow up on this as we go throughout the day. I should point out that German Chancellor Olaf Scholz and President Emmanuel Macron of France will be discussing Gaza with President Biden and Prime Minister Rishi Sunak later on today as well. As we just take a look at where we're settling here on this at midday, you got the Nasdaq 100 still off by about 0.5%, S&P down just 0.3. Obviously, the move in the dollar, you obviously have the move in the oil. It is very much a risk-off template kind of day. Coming up, you do have Amazon Prime Vice President. We'll be joining Bloomberg Technology with Caroline Hyde and Ed Ludlow. That wraps it up for me and Guy. This is Bloomberg.